what happens with a lot of businesses is they have an event, which we'll talk about on the checklist here in a little, in a couple of podcasts. They'll have an event and they'll go on sale. They're very clearly on sale. You got a 10 cap price, you got a payback time price, the margin of safety price. You can buy them on sale. And then they recover so quickly, often in the real world, that they'll just jump up in a year. And suddenly this thing that you bought for $20 is now at $40 and back where it was. Well, if that's intrinsic value, if that's sticker, $40, and you bought it at margin safety price, now you're back to sticker and the company's growing at 7% a year, you're not going to see a 26% return for a 10-year period. You got 9 more years to go. And those 9 years, if the market stays rational, will be a 9% return per year. So you just hammered yourself. So what Buffett did early on in the early Warren Buffett partnerships is when that stock price would get up to where he wanted to sell it, he would sell it and move the money to something else to keep the velocity high. Now, he doesn't do that today.
Yeah.
Because he's not nimble anymore. He can't just move around $100 billion. It doesn't work. You're going to crush the stock prices every time you try to get out. And he very famously talked about that with Coca-Cola back in 1988 or 1998 or 1999. Coca-Cola was up at around $75 a share or something, well above what it was worth. And people were going like, why are you staying in this thing? It's so overpriced, according to all of the criteria you've always taught us. And Buffett just said, look, I'm just not nimble like I used to be.
True.
If I could move the money around like I used to when I had $1 million or $5 million, I'd be making 50% a year. I mean, straight up, he said that. I can't do that anymore.
At the same
but
time,
you can.
There's a lot. I mean, now we're talking about selling, not buying. But there's a lot of money to be lost in a what is that? A mistake of omission in getting out of a company too early.
Yes,
and
there is.
I've made that mistake already,
I have
and it
too.
sucks.
That's my most common mistake, and it sucks.
It's also the mistake I hear the most from other investors.
Yep.
Over and over, trying to not really time the market. It's more like time the company. It's saying like, okay, you're fully priced now. Your stock's fully priced. Like, this is what I expected to happen. Everything happened the way I thought. So great. Best of luck. I'm out of here and on to the next thing. And then we don't anticipate that a given company can come up with such genius ideas and grow itself.
Well, two
into
things
new
come
areas.
out of this, really.
So it's frustrating.
The first is that being rational in this market for the last 5 years is not common, and the prices that we're seeing in the market are not rational.
Definitely.
They don't reflect the ability of a company to perform over time and give you a return that's a risk-adjusted return. They just don't reflect that at all.
Yeah.
The prices we're seeing in the market now are insane, and as a result, you're just not going to get what happens is you buy a company that gets put on sale, let's say during COVID last March or in 2020. And when this company comes back up to a reasonable sticker price, it could continue running because our view of a reasonable sticker price is very conservative. We're saying, based on conservative views of the market, what the value of that business is. And the market is nothing conservative about it, and it just keeps pushing the price up. I mean, Chipotle is the classic one of these where, I'm getting out at around 500, and it's now at 1,500, and I feel like an idiot because I'm sitting here thinking about valuing this company in a traditional stock market, and we're not in one, and I just made that mistake. But I also want you guys to realize that if you're going to make a mistake, this is the one to make. Okay, this is the mistake Buffett makes from time to time, back especially in the early days, of getting out of a business when it's not even anywhere near its sticker price. He still would get out of it. He'd get out of these companies at the margin of safety price.
Yeah.
He'd be buying at half of margin of safety. And so this is the mistake to make, because just think of what I just said. I effectively doubled my money in Chipotle, and I'm upset because I didn't quadruple it. That's not a bad thing to have happen, only to double your money in a year or so. So the worst part of that is there's just nowhere else to put the money, and I hate that, but that's just the way it goes.
Yeah, but I think it's more of a mistake than that, because for me, my mistake was not realizing the potential that a company had, thinking that they were fully valued, thinking, okay, it's done what it's going to do.
What company are you talking about?
No, it's the same. It's Chipotle.
Well, wait. They haven't produced massively insane numbers.
No, but they've produced very good numbers in the midst of massive restaurant closures.
Yeah, but those good numbers are right on track with a 20% growth rate.
Yeah, exactly.
Which I priced the company at and came up with a sticker at. And they have just exploded beyond that. They're double a reasonable valuation.
The price is more than it should be, for sure. But I thought that it would get to 600, 700, and that would be like its future. And it would be a company that sold burritos. And it's turning into better than that. Like, I think this company's going to be amazing. Anyway, I don't want to say too much about Chipotle.
Oh, man. I priced that thing according to a major growth rate like that.
Poorly.
I didn't.
In my opinion.
I priced it where it should be, and I'm very confident that it is so massively skewed to where it shouldn't be, along with pretty much the rest of the market.
Yeah, but I wish that I had stuck with it for all of its future growth. Not because of the market overvaluing it, because I didn't realize what this company was going to be doing. So that's my mistake.
Okay, we took different views of it and came up with the same number to exit on. Somehow. We can talk about that anytime you want to, because we shouldn't have different views of this and come up with the same number. It should be very different numbers.
Okay, yeah, that's you're right about that.
Let's see which one of us.
But I think that's what I'm saying. I think that's what I'm saying is I did my calculations on that based on the company that it was. This is a company that has stores that sells at lunch and dinner time. And they're going to open more of them. And what I didn't take into account was all the other things that they're doing to not only grow Chipotle, but I think to grow probably into a very large restaurant company of various brands. So it'll be interesting to see what they do. But that's the part that I missed out on.
Okay. I don't know. I mean, I had a big growth rate on those guys when I calculated sticker. Big growth rate on them. That they're going to do that for essentially as long as I was interested in the investment. And still came up with that $600 to $700 range. 100%.
Okay.
100%.
Okay.
And I'll bet you if you do the math on it right now, you won't come up with much more. You certainly won't come up with $1,500 a share, I promise you. And the reason
I've said 3 times it's not $1,500. Yes, right. I agree.
So the reason is because of the kinds of things we do during this discounted cash flow analysis, which we better get back to.
Okay.
So first off, the growth rate, obviously is somewhat subjective here. And then the next one.
Wait. So what's, okay. Valuation, margin of safety. What is point number 1?
I can pinpoint the long-term growth rate of earnings and cash flow.
I can pinpoint the long-term growth rate of earnings and cash flow.
Okay. And I'm going to be fairly optimistic here. All right. Number 2, I'm going to keep moving because we're not going to sit here and wait while you write everything down. Okay. Number 2.
We sure
the projection.
Because I'm not going back to this again.
God,
okay, go ahead.
I hate this. All right. My projection of future earnings and cash flow takes the company to nowhere near the industry ceiling.
Ooh.
Now, probably we could write this down differently, but the main thing here is I'm looking out 10 years and seeing what the revenue stream, right, what the earnings could be based on revenue of this company, and realizing that, I guess this company would have to be the only restaurant in America to produce these kinds of numbers.
I like that one.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.